Hello, everyone. Today we're going to explore a financial field full of both controversy and opportunity: private digital currencies. Imagine, the money in your hand no longer depends on a government printing press, but is instead maintained by a global network of computers. Every transaction you make is as fast and immutable as sending an email. This is not science fiction. It is the financial world that Bitcoin and Libra, or Diem, are striving to build. In this lesson, through real-world cases and comparative analysis, we will unveil the mysteries behind these two digital currencies. Learning objectives for this lesson: 1. Master the core technological principles and design concepts of Bitcoin and Libra, or Diem. 2. Analyze Bitcoin's value logic as digital gold, along with its main risks. 3. Understand the problems Libra, or Diem, sought to solve, and the regulatory and market challenges it faced. Next, let's get to know Bitcoin, often referred to as digital gold, whose rise has been surrounded by controversy. In the midst of the 2008 global financial crisis, a mysterious figure under the pseudonym Satoshi Nakamoto published a white paper proposing a peer-to-peer electronic cash system. On January 3, 2009, the Bitcoin network officially launched, with the very first transaction recorded between Satoshi Nakamoto and cryptography expert Hal Finney. Its core innovations include: 1. Blockchain technology. All transactions are recorded on a distributed ledger, with each block containing the hash value of the previous one, forming a tamper-resistant chain. 2. Proof of work. Miners compete to solve complex mathematical problems to earn the right to record transactions, ensuring network security. 3. Fixed total supply. Bitcoin's maximum supply is capped at 21 million coins, with block rewards having roughly every 4 years. Over 19 million are already in circulation today. Typical case: in 2010, programmer Laszlo Hanyecz used 10,000 bitcoins to buy 2 pizzas. At today's prices, that meal would be worth over $1 billion, making it the most expensive takeaway in history. The value of Bitcoin derives from 3 dimensions. 1. Scarcity. With a supply cap similar to gold, its limited issuance attracts investors to regard it as digital gold. 2. Decentralization belief. Users support the network by running nodes or mining, fostering a self-sustaining system of trust. 3. Global liquidity. In countries with hyperinflation, such as Venezuela, Bitcoin has become a tool for residents to hedge against currency depreciation. Risk warnings include: 1. Price volatility. In 2017, Bitcoin surged from $1,000 to $20,000, only to crash by 80%, leaving countless investors ruined. 2. Regulatory uncertainty. While China has imposed a complete ban on Bitcoin trading, El Salvador declared it legal tender, with such policy divergence amplifying market volatility. 3. Environmental cost. Annual Bitcoin mining consumes more electricity than the entire nation of Argentina, prompting the United Nations to condemn it as a climate disaster. Typical case: in the world's largest Bitcoin money laundering case in 2024, Chinese company Lantian Grue illegally raised 43 billion renminbi. Ringleader Qian Jimin converted the illicit funds into 61,000 bitcoins and fled to the UK, where a London court eventually froze the assets. This case exposed how Bitcoin's anonymity can be exploited by criminals. Next, let's turn to Libra, or Diem, tech giant's monetary experiment. In 2019, Facebook, together with 28 partner institutions, launched Libra, later renamed Diem, in an attempt to build a global digital currency infrastructure. Its core features included: 1. Stablecoin mechanism. Each Libra or Diem token was backed by a basket of fiat currencies, USD, Euro, etc., and short-term government bonds, with value fluctuations kept within 1%. 2. Centralized governance. The reserve was managed by the Switzerland-based Libra Association, whose members included financial giants such as MasterCard and PayPal. 3. Low-cost cross-border payments. Libra or DM promised transfer fees less than 1/10 of traditional remittance costs, with near-instant transaction speed. What are the key differences between Bitcoin and Libra or DM? We can compare the two directly through this table. What controversies and challenges did Libra/DM face? Let's continue our exploration. The controversies and challenges for Libra or DM include: 1. Regulatory resistance. The G7 required Libra or DM to meet strict standards on anti-money laundering and data privacy, leading to repeated project delays. 2. Trust crisis. Facebook has been caught up in user data breach scandals for multiple times, while central banks questioned whether the company could responsibly manage currency reserves. 3. Market competition. The rapid development of central bank digital currencies, CBDCs, such as China's eCNY, which already piloted in 1.5 million scenarios. Typical case. In 2020, the Libra Association sought cooperation with the U.S. Federal Reserve, proposing to raise the U.S. dollar's share of its reserve basket to 50% in exchange for regulatory approval. However, the request was rejected on grounds of national security risks. This setback highlighted the deep conflict between private digital currencies and national monetary sovereignty. Will the future of digital currencies be one of disruption or coexistence? Let's continue our learning. Trends in digital currency technology convergence. 1. Bitcoin's evolution. The Lightning Network improves transaction speed. The Taproot upgrade enhances privacy. Institutional investors participate indirectly through ETFs. 2. Libra/DM's transformation. After being renamed DM, the project shifted to a single US dollar peg, aiming to become a digital USD stablecoin. Exploration of digital currency regulatory frameworks. 1. China's approach. All cryptocurrency trading is banned, but blockchain technology innovation is supported. For example, the Blockchain-Based Service Network, BSN, has achieved global coverage. 2. U.S. strategy. The SEC classifies most tokens as securities, while the CFTC regulates Bitcoin futures, forming multi-agency supervision. 3. EU framework. Through the Markets in Crypto Assets (MiCA) regulation, stablecoin issuers are required to hold equivalent reserves in traditional fiat currency. Today we are exploring not just technology or financial instruments, but also major issues concerning national sovereignty, economic security, and social trust. The rise of private digital currencies like Bitcoin is, at its core, a challenge to traditional currency issuance and national financial sovereignty. As illustrated by cases ranging from Lantian Gurue's use of Bitcoin for money laundering to the regulatory boundaries encountered by the Libra or DM project, financial innovation must operate within the framework of national laws and regulations. Any attempt to bypass oversight or challenge sovereign credit will ultimately jeopardize both national interests and financial stability. From Bitcoin's grassroots revolution to Libra or DM's corporate power struggles, digital currencies are reshaping the underlying logic of the financial world. As future finance professionals, you need not only to understand the economic principles behind the technology, but also remain vigilant against bubbles and risks. Finally, please complete the following exercises. That's the end of today's lesson. See you next time.